Matthew made $72,000 a year as a project coordinator at a marketing firm. On paper, he was doing everything right. He had a stable job, a decent apartment, and he paid his bills on time. Every month he watched money leave his bank account: rent, groceries, insurance, student loans, and the occasional dinner with friends. By the end of the month, there was barely anything left. It didn't make sense. $72,000 sounded like a lot of money when he first got the job. His parents had always told him that once he reached that income level, life would feel comfortable. But somehow every year felt exactly the same. Work hard, pay bills, wait for the next paycheck, and repeat the cycle again. One afternoon Matthew walked into his bank with an idea that he believed could finally change that cycle. For the past year he had been building a small side hustle designing websites for local businesses. It wasn't huge yet, but the numbers were promising. 2 of his clients were already paying him $1,200 a month each, and a few more businesses had expressed interest in hiring him. Matthew believed that if he could dedicate his full time to it, the side hustle could grow into a real agency. All he needed was a little time and a small financial cushion. So he asked the bank for a $20,000 small business loan to help him transition away from his job. Matthew came prepared. He had a detailed spreadsheet, projected revenue numbers, and a simple plan explaining how he would grow the business over the next year. The loan officer listened carefully and nodded politely as Matthew explained everything. For a moment it felt like things might actually work out. But then the loan officer explained the requirements. To qualify, Matthew would need at least 2 years of business tax returns, audited financial statements, and collateral worth more than the loan itself. Matthew didn't have any of those things because the business was still new. The answer was simple and final. Application denied. Matthew left the bank feeling embarrassed and frustrated. Maybe the idea had been unrealistic. Maybe he wasn't as financially responsible as he thought he was. But a few weeks later something strange happened. He received a letter in the mail from the exact same bank. It was a pre-approved offer for a $42,000 auto loan. There was no requirement for a business plan, no request for financial projections, and no collateral necessary. All they needed was his salary information. The bank was completely comfortable lending him tens of thousands of dollars to buy a car that would immediately lose value. But they would not lend him a smaller amount to build something that could increase his income. At first Matthew assumed that it was simply how banks operated. Everyone says banks avoid risk. That explanation sounded reasonable on the surface. But the more he thought about it, the less logical it seemed. Because Matthew already had access to a surprising amount of debt. His credit cards alone had a combined limit of almost $28,000, and the bank regularly sent him emails offering to increase those limits. If he applied for a personal loan, he could probably qualify for another $15,000 without much trouble. And if he wanted to buy a house someday, the bank would likely approve a mortgage of nearly $280,000 based on his salary. When Matthew added all those numbers together, he realized something surprising. He could easily access more than $350,000 in debt. Just not the $20,000 he wanted to use to build income. That realization led Matthew to a deeper understanding of how the financial system works. Banks are not just evaluating risk. They are evaluating predictability. A salaried employee with regular bills is extremely predictable. Every 2 weeks a paycheck arrives, and every month payments leave the account. Mortgage payments, car payments, and credit card payments follow a predictable pattern. It creates a stable financial cycle that banks understand perfectly. But a successful business owner introduces uncertainty. If Matthew's agency became successful, his income might double or triple. He could pay off debt quickly or stop borrowing altogether. From the bank's perspective, that future is less predictable. The numbers behind the modern financial system reveal something interesting. In the United States alone, total consumer debt has climbed to around $17 trillion. Most of that debt is not connected to building wealth. Instead, it is tied to consumption. Mortgages, car loans, credit cards, and personal loans dominate the system. Nearly all of these financial products are approved based on one central number: your salary. Your income determines the size of your mortgage. It determines your credit card limits and your borrowing capacity. The entire structure assumes that your current salary represents the highest financial capacity you will ever have. Think about what that assumption does to people's financial lives. If someone earns $70,000 per year, the system organizes their entire financial reality around that number. They are offered loans that support a lifestyle built around that income. Car loans are a perfect example. The average new car price in the United States has approached $48,000. Most buyers finance that purchase for 6 or 7 years. By the time interest is included, they may pay more than $55,000 for a vehicle that steadily loses value during that time. Yet banks approve these loans very quickly because the monthly payment fits comfortably inside the borrower's salary. Meanwhile, a person asking for $30,000 to start a small online business faces a completely different level of scrutiny. That same $30,000 could potentially generate thousands of dollars per month if the business succeeds. But because that income does not yet exist, the request is considered risky. This difference reveals an important truth about the system. Debt for consumption is easy to access, while capital for wealth creation is significantly harder to obtain. Advertising reinforces this pattern in subtle ways. Financial marketing rarely encourages people to borrow money to build assets. Instead, advertisements focus on lifestyle upgrades. Messages tell people that they deserve a nicer car, a better vacation, or a more luxurious experience. Borrowing becomes associated with comfort and reward rather than long-term ownership. Over time, people begin to think about financial decisions in a very specific way. They stop asking whether something builds wealth and start asking whether they can afford the monthly payment. That simple shift in thinking is powerful. Affordability keeps decisions tied to current income. Wealth, however, is rarely created through affordability alone. It is built through ownership. Ownership of businesses, investments, and assets that produce cash flow or appreciate in value over time. When Matthew understood this, he realized that waiting for the bank's approval might prevent him from ever starting. Instead of giving up on his idea, Matthew decided to take a different path. He kept his job for another year but redirected most of his extra income into growing the business. He invested in better software, marketing, and a few freelance designers who could help him handle more projects. The schedule was exhausting. He worked long nights and weekends while balancing his full-time job. There were many moments when he wondered whether the bank had been right to reject him. But gradually the business began to grow. 3 clients became 5. 5 became 8. Within 18 months Matthew's side hustle was generating around $8,000 per month in revenue. That amount was higher than his salary. Eventually he left his job and committed fully to the business. 2 years later the agency had expanded into a small remote team with 6 employees and annual revenue approaching $500,000. Ironically, the bank that once rejected his loan began contacting him again, this time offering investment services and business credit lines. But Matthew no longer needed the bank in the same way. He had built something more valuable than a paycheck. He had built equity in a system that produced income. The numbers that once made Matthew feel broke finally started to make sense. Many people do not feel financially trapped because they earn too little. They feel trapped because their financial lives are structured around consumption rather than ownership. A person earning $60,000 while slowly building assets can eventually achieve financial freedom. Another person earning $120,000 while financing an expensive lifestyle may always feel like they are falling behind. The difference is not income. The difference is direction. Every dollar you earn can move you toward consumption or ownership. Toward payments or assets. Toward dependence or independence. The financial system often nudges people toward the first option because it is predictable and profitable. But once you recognize the pattern, you gain the ability to choose a different path. Your salary is not a measure of your potential. It is simply the price someone currently pays for your time. Real wealth begins when you stop organizing your life around that number and start focusing on what you can build and own. Over time, replacing income with ownership slowly removes the ceiling that once seemed impossible to break.